You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today, Ryan and I will be taking questions from our Facebook community as well as perhaps the whole CPA community to see what people have for these summer months. There's a lot of things going on. It's a great time to get your tax situation in order and plan for the rest of the year. So if you have questions, we may just be answering yours today here on the episode. Stay tuned. We'll be diving into all of that in just 1 minute. Tap into real asset ownership with mineral rights and working interest opportunities, a smart way to invest directly in oil and gas production. Gain monthly income potential, upside exposure to commodity markets, and equity in the ground. Even better, mineral rights qualify for 1031 exchanges, allowing you to reinvest the proceeds from real estate and other qualifying assets while deferring capital gains. This is real estate under the ground, title deeded and owned in perpetuity. Whether you're seeking cash flow, long-term wealth preservation, or favorable tax treatment from working interests, these opportunities offer hard asset advantages with energy market upside. Don't just watch the oil and gas industry grow, own a part of it. Contact Eckert Enterprises today at eckertenterprises.com/taxsmartrei to learn more about how you can put mineral rights to work in your portfolio. Again, that's Eckert Enterprises/taxsmartrei to learn more about how you can put mineral rights to work in your portfolio. That's it for now, but we'll dive right into today's episode. All right. And we are back. And again, we'll be taking questions from our Facebook group today. We did have a guest plan, but it looks like we had a scheduling issue. So we'll postpone that episode and we'll bring you answers to your questions directly here on the episode. All right. So we have the first one here, Ryan. I'll kick this one over to you. Can I put a short-term rental under an LLC, even if the deed and mortgage are under my name? The purpose of this is to have the STR have a bank account and line of credit with the LLC.
Yeah, you can do that in order to officially move the property to under, right? Kind of the wording here, under the LLC. You are going to need to do some sort of a quick claim deed, changing the deed, the title, to be now owned by the LLC instead of your name personally. With the mortgage, because that's being brought up, you will want to consider talking with the lender and just tell them if it's been in your personal name that you're doing that. A little bit better to be safe than sorry. Tell them what you're doing, kind of why you're doing it, and essentially get some sort of like an approval. Every bank's a little different, so forgive me if there's lenders listening, but get some sort of like an approval and kind of let them know. You just want to be careful of triggering any sort of due on sale clause, especially if there's, like you said, you've got mortgage, we've got financing. So just be careful there. But yeah, if you do that, you can use the bank account credit line from the LLC associated with that. Not an issue. You're not going to, have any other issues from a tax perspective if there's other questions around that and well, kind of grouped into that. But yeah, that's fine.
Yeah. All right, cool. With that said, just to note, you can transfer it without letting your lender know, but there's a risk that they could execute the due on sales clause. Just to be transparent. Like, you can do it that way. Just if you're listening to this and you said, wait, do I have to do that? No, but there's a risk that could cause problems. Small risk, but it's still there. So if you want to be sure, go ahead, ask for approval. But yeah, long story short, if you want your LLC to own the property, you have to transfer the deed over. All right, we got another one here. And this is on the grouping election. All right, so 2025 will be my first year with short-term rental. Congratulations on your first short-term rental. My long-term rentals have a grouping election. I plan to keep the short-term rentals separate. They're not part of this grouping election, which is the correct way to handle it. They can't be part of that same grouping election if I'm tracking this properly so far, as my time logs will be separate from my short-term rental to qualify for the STR loophole. Does anyone agree that the short-term rental should not be included in the election on my 2025 tax return? So I think what they're talking about here is the -9 election, the election for real estate professionals. That's what I'm gathering through the lines here. And basically, when you are making, so we'll back this up, we'll be brief. We've covered the real estate professional status in depth on plenty of other episodes. You can go back and check those out, the rep series. But with the real estate professional status, you have the option to treat all of your quote unquote rental activities as one activity for the purposes of material participation. Now, the reason why people make this election is because if they did not make this election, they'd have to meet a material participation test on each and every single one of their long-term rental properties. So by grouping it, you're basically saying I have one big rental property is essentially what you're saying to the IRS. And you're combining all of those hours into one test, which is fantastic. A lot of people do that. The issue is short-term rentals are not rental activities underneath the tax code. And that's what makes them unique and what makes the short-term rental loophole compelling to so many people out there who can't qualify for reps. However, in situations where you do qualify for reps and you're looking to use a short-term rental loophole, or you do have a short-term rental, because again, that short-term rental is not a rental activity, cannot be grouped in with your short-term rental. So to answer this question, does everyone agree that short-term rental should not be included in the grouping election on 2025? I can't speak for everybody, but I will tell you that it should not be included in that -9 reps grouping election. The only time you should be grouping your short-term rentals is when you're using the -4 election to group all the short-term rentals together, for the most part. So Ryan, I don't know if you have anything to add to that one.
Yeah, I mean, you just basically can't with the -9 election, which is used for real estate professional status, because a short-term rental, if it's an average stay less than 7, is not a rental property. Like, period. You basically just can't, like, legally. You could kind of conceptually think that you are, but the whole election itself, the requirements and criteria aren't going to even allow you to do that. So yeah, I would agree. Yeah, you aren't going to group those together, the short terms and the long terms. Correct.
Cool. We'll see what else we have here. I purchased a fourplex around 2010 and had all sorts of tenant issues through 2023. Sounds pretty rough. 13 years of issues. I don't know if I would have been able to withstand that. In 2024, I finally had the tenant evicted by the sheriff, and outside of one unit, which remained occupied with no rents charged, started remodeling the project. Okay, this one's a little lengthy. Okay, what he's basically asking is, because of this, was the property placed in service for the sake of repairs and maintenance, and some of these things be deducted as repairs and maintenance, or should they all be capitalized because the property was theoretically no longer in service? And Ryan, I'd love to get your take on that, and I could go.
Yeah, so basically part of the question is the property placed in service? And I hear the nuance of, hey, they're not paying rent and things like that. Really doesn't matter as far as the code goes. Like, it doesn't matter if they're paying rent. They are there. It is placed in service. It is habitable, and they are renting the place. Truly, there's a lease and things like that. So they're renting it. So yeah, those costs, those renovations, we would be analyzing then the tangible property regulations, going through things like de minimis, safe harbor, and so forth, the $2,500 rule, and evaluating, hey, does it meet one of these repair regulations? Or if not, then we're going to be looking at things like the bar tests, which we've also covered in other episodes, betterment, adaptation, restoration, reviewing that. And that's ultimately going to help us understand, is this a immediate expense that we can consider a repair? Or is this something that we need to capitalize and therefore depreciate according to the specific property type that it is?
Yeah, I think that answers the question there. It's still placed in service, even though they're not paying you rent. It doesn't mean that it's not placed in service. You have to go chase them down for the rent or evict them or whatever the case may be. But it's still very much in service there. So I think that's the crux of the question. All right, we got another one, another short-term rental one. Everybody loves short-term rentals. So if I completed a short-term rental in 2022 and placed it into service, but did the cost seg in 2025, can I claim 100% bonus depreciation? And does the tax savings count for 2022 or 2025? We get this question a lot, more or less. I'll go ahead, I'll break this one down, okay? So you purchased a short-term rental in 2022. That's the year you placed into service, okay? With bonus depreciation, the way it works, it's called first-year bonus depreciation, which means you're supposed to take the depreciation in the first year the property is placed in service. That's the way it's supposed to technically operate. And you're going to be eligible for bonus depreciation based on the year you placed in service. So in 2022, bonus depreciation was 100%, okay? Now you didn't take it. So that's technically incorrect, okay? So the way we fix this is you would still claim the bonus depreciation in 2025, but you need to use Form 3115 and a 481A adjustment to fix that. So you'd be taking the depreciation that you should have taken in 2022 and moving it into the 2025 year. So it would be 100% because you placed a property in service in 2022, but you would be reporting it on your 2025 tax return, assuming this is the year that you quote unquote corrected it. Again, using those forms, which you can ask your CPA about. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. Is there a way to change the Airbnb income earned via a corporation in order to contribute it to a solo 401k? You want to take that one?
So the short answer is no. If we're looking at simply having the rental income run through a corporation, the entity structure isn't going to change the tax. The only way that you could potentially have something related to earned income that's related to like rental properties in general would be something like a management fee, like a property management fee. We just need to be careful there if it's just your own entities and so forth. There could be somewhat of an issue there, but the short answer is no, even if you change the entity type. That's kind of the short answer. So just need to be careful there. The only potential way is a management fee, but still need to be careful if it's just like you're doing your own rental properties.
Yeah. And there's another way you could do with Airbnb. Actually, it would be providing substantial services to your guests that would make it subject to the self-employment tax, which could open up the door for solo 401k contributions. That is another way to do it, specific to short-term rentals. But yeah, normally rental income is not subject to self-employment tax, and that's kind of the trigger for being eligible to contribute to a 401k or an IRA or what have you. So that's the answer to that question there. Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation. We don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode.
Next one is, if I am attending a conference related to my business in 2025, but I paid for it last year in 2024, which year of taxes do I write it off as a business expense?
So the first thing I'd ask is the business placed in service in 2024, right? Was the business running in 2024? If it was running in 2024 and you're on the cash basis of accounting, right, you would be writing it off in 2024 despite the event taking place in 2025. If your business was not in service in 2025 and it was just like an educational event that you went to, you might have a case for it to be a startup cost associated with your business. So that would be the answer there. The answer is it depends, and that's something you may want to clarify with your CPA regarding the specifics of your situation, but that's generally how it'll work. Here's one from Luke Visold. I'm splitting a commercial real estate deal 50-50 with another investor and plan to use some of the hours spent managing this investment towards achieving my real estate professional status. Is there anything specific I need to keep in mind before entering into a 50-50 investment split with another person? For reference, I have 6 other long-term rental properties, 1 commercial and 5 residential, that all add to my reps hours.
In general, because you are going to have another, I'm going to assume long-term rental because we're talking about commercial. I'm not going to assume any sort of like hotel or anything like that. You can basically group that timing with your other times that you have, like you mentioned, 1 commercial, 5 residential, and so forth. You can group all those properties together. Now, just like we were talking about at the beginning of this episode, we've got to do the -9 grouping election to say, hey, all of our rental activities, the time we're going to group together to help you meet either, the 750 hours, more than half your time, and or material participation. Like you said here, you're involved in the management of this investment property. The short answer is yes, you definitely can. Now, something to be careful here, I see in the comments from actually Nate, is what type of property is it? Meaning, is this a property that is like a new construction, or is this a property that's a flip and it's not ever going to be a rental? So there are considerations there just with this specifically. And I think there's an answer further down. I think it's just going to be a normal rental property and so forth. And therefore, that would go to my first answer. But you do need to consider other things for those of you listening. Is this a flip? Is this brand new development, ground up construction? That could have differing answers depending on you kind of where it's at as far as an asset class and so forth.
Yep. That's pretty much how it works. All right, so we're going to take maybe 1 or 2 more questions here today, folks, and then we're going to go ahead and wrap this one up. We will be back over the coming weeks with a few special guests, which we're really excited to have on. So this will be the last solo episode with me and Ryan for at least the next 2 weeks. but we will see how the schedule, how that cookie crumbles. All right, so this will be the last question for today, and that is, since the building was placed in service in 2023, and we began using it as a medical office at that point, the cost segregation study was not completed until 2024. Can we still claim bonus depreciation in 2024 based on the study results, or are we limited to depreciating the reclassified components over 5, 15, and 39 years? So this kind of goes back to the same issue we talked about on one of the previous questions. So the property was purchased and placed in service in 2023. In 2023, bonus depreciation was 80%, just for anybody who was wondering. That means that had you done the cost segregation study in 2023, you would have gotten 80% bonus depreciation on that 5, 7, and 15-year property. However, it sounds like that was not done in 2023, and now we're looking at 2024 when you did the cost segregation study after the property was already in service in 2023. So we're going to have to look at using a Form 3115 and a 481A adjustment to take that depreciation that was supposed to be done in 2023 and move it into 2024. Okay, that is how it works. Now, there's one more caveat here I can say. If you have not already filed your 2024 tax return, you can actually go back and amend 2023 and still claim the first year bonus depreciation on 2023's tax return. But that is a unique situation in where this recently just happened on the prior year tax return and you did not file the current year's tax return yet. Otherwise, if you've already filed 2024, you would have to basically do what I just said with the 3115. Hope that makes sense out there. When you're dealing with retroactive cost segregation studies, it is important to get guidance from a experienced CPA so that you know what you can and can't do and what years things will apply to. Because, for example, it may or may not make sense to take it in 2024. Are you looking at qualifying for reps or short-term rentals? Not really clear what type. Oh, it's a medical office. Probably reps at this point. Does it make sense to do it? Or should you be holding off till 2025 and perhaps because you qualify for reps then? Or maybe you don't qualify for reps. It doesn't make sense to do it all, right? There's a lot of other factors that go into planning around one of the more complex things here. So definitely want to speak to your CPA on that before pulling the trigger on a retroactive cost segregation study. But again, that's all for today. We have some special guests lined up for the next few weeks. Really excited to bring those folks on. So stay tuned and we'll see you on next week's episode of the Tax Smart REI Podcast.